Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Imagine investing money that travels across oceans, navigates complex global economies, and potentially earns you returns while you sleep. Today, we're unpacking the fascinating world of international bonds, where your dollars become global ambassadors.
Wait, so these aren't just boring financial instruments. This sounds like financial diplomacy, but help me understand. Why would an average investor care about bonds from another country?
Great question. International bonds are like economic passports. They allow everyday investors to participate in global economic growth while potentially reducing portfolio risk. In the next hour, we'll reveal how a Brazilian government bond or a Japanese corporate debt could be your next smart investment move with opportunities most people don't even know exist.
Welcome back to our deep dive into the world of bonds. In previous episodes, we explored treasuries, corporate bonds, and municipal bonds so far. Let's start this episode on international bonds by tackling a crucial factor that can make or break your international bond investments: currency risk.
Right? I think it's something about being exposed to changes in exchange rates. That sounds like it could really complicate things. Can you break this down for us?
Absolutely. When you invest in foreign bonds, you're not just betting on the bond's performance itself, you're also taking on the risk of currency fluctuations. Let's say you invest in a bond denominated in euros. If the euro strengthens against the US dollar, the value of your investment will increase, even if the bond price remains the same. On the flip side, if the euro weakens, your returns could suffer, regardless of the bond's individual performance.
So it's like a double-edged sword. Currency movements can either supercharge your returns or eat into your profits.
Exactly. And this is where many investors get tripped up. They might pick a winning bond, but end up losing money due to unfavorable currency shifts.
Wow, that adds a whole new layer of complexity. How can investors manage this currency risk?
There are a few strategies investors can employ. One is to choose bonds denominated in US dollars, which are known as hard currency bonds. This essentially eliminates the direct currency risk. Another approach is to use currency hedging strategies, which involve using financial instruments to offset the potential impact of exchange rate movements. Finally, diversifying across multiple currencies can help spread the risk. By investing in bonds from different countries, you reduce your exposure to any single currency.
Those are some great risk management techniques. It really highlights the importance of understanding these unique risk factors before diving into international bond investing.
Definitely. It's not just about picking the right bond. You have to consider the broader economic and political context, too.
That's a great point. Country and regional risks play a huge role in international bond performance. Changes in government, economic policies, and local market conditions can all have a significant impact.
And each market comes with its own set of challenges, right? Like differing regulatory environments, transparency levels, and even natural disaster risks.
Absolutely. Investing in international bonds is not a one-size-fits-all approach. It requires careful consideration of these various risk factors.
This is a lot to take in, but it's really eye-opening. I'm starting to see how international bonds could fit into a diversified portfolio as long as you understand and manage the risks.
And that's the key takeaway here. International bonds can offer compelling opportunities for investors looking to diversify and potentially enhance returns. But as with any investment, it's crucial to do your due diligence and approach these markets with a strategic, risk-aware mindset. We discussed the importance of understanding currency risk when investing in international bonds. Now, let's explore how these investments can fit into a well-diversified portfolio.
That's a great topic. I'm curious to know more about the role international bonds can play in an investor's overall strategy?
International bonds can serve several key purposes in a portfolio. First and foremost, they provide geographic diversification. By investing in bonds from different countries and regions, you can spread your risk across various economic cycles and market conditions.
That's a crucial point. Diversification is all about not putting all your eggs in one basket, right?
Exactly. International bonds allow you to participate in the growth and stability of markets outside your home country. This can be especially valuable during times when your domestic market is underperforming.
So it's a way to potentially smooth out returns over time.
Yes, that's the idea. Of course, it's important to remember that international bonds come with their own set of risks, as we discussed earlier with currency fluctuations.
Right? And there are also market-specific factors to consider, like political risks and varying regulatory environments.
Absolutely. That's why it's crucial to approach international bond investing with a strategic mindset. This means carefully selecting the countries and regions you want to invest in, understanding the local market dynamics, and being prepared to hold these investments for the long term.
So it's not just about chasing the highest yields.
No, definitely not. While international bonds can offer the potential for enhanced yields compared to domestic bonds, chasing returns without considering the underlying risks can be a dangerous game.
That's a great point. It's about finding that balance between risk and reward and understanding how these investments fit into your overall financial goals.
Exactly. And for many investors, international bonds can play a valuable role in achieving those goals. By providing diversification, potential yield enhancement, and exposure to different economic cycles, they can help create a more resilient portfolio.
This is really helpful context. It's not just about the individual bonds themselves, but how they work together within a broader investment strategy.
Absolutely. And as with any investment decision, it's important to do your due diligence and consider consulting with a financial advisor to determine if international bonds are right for you. If you'd like personalized guidance, you can reach out to us at safesimplessound.com/contact.
That's great advice. Every investor's situation is unique, and what works for one person may not be the best fit for another. The key is to approach international bond investing with a clear understanding of both the opportunities and the risks involved.
This has been a really enlightening discussion. I feel like I have a much better grasp on the role international bonds can play in a diversified portfolio.
Fantastic. That's exactly what we aim for with these conversations, to help investors make more informed decisions about their financial future.
And there's always more to learn.
Exactly. Now, let's take a closer look at the two main categories of international bond markets, developed and emerging.
That's right. Developed market bonds are issued by countries with strong, stable economies like Japan or Germany. These markets generally offer lower yields, but also tend to be less risky.
So they're kind of like the blue chip stocks of the international bond world.
In a way, yes. Developed market bonds can provide a solid foundation for the international portion of your bond portfolio. They offer diversification benefits without taking on excessive risk.
And then on the other end of the spectrum, we have emerging market bonds. These are issued by countries with developing economies, right?
Exactly. Emerging markets like Brazil, India, or Indonesia offer the potential for higher yields, but they also come with more uncertainty and risk. Factors like political instability, currency fluctuations, and less developed market structures can all impact the performance of these bonds.
So it's a trade-off between potential return and risk.
That's a good way to think about it. Emerging market bonds can be an attractive option for investors seeking higher yields, but it's crucial to understand the additional risks involved.
And that's where diversification comes in, right? By investing in a mix of developed and emerging market bonds, investors can potentially balance risk and reward in their portfolios.
Absolutely. Diversification is key when it comes to international bonds. By spreading your investments across different countries and regions, you can help mitigate the impact of any one market's performance on your overall portfolio.
That makes sense. But with so many countries and bond options out there, how do investors know where to start?
Great question. One approach is to look at the current market trends and opportunities. Right now, we're seeing some promising developments in emerging markets, like resilient economic growth expectations and the potential for monetary policy easing.
Those sound like positive signs. But as always, it's important for investors to do their own research and consider their individual goals and risk tolerance before making any investment decisions.
Definitely. And that's where a financial advisor can be incredibly valuable. They can help you assess how international bonds might fit into your overall investment strategy and guide you toward the options that align with your specific needs.
That's really helpful advice. I think the key takeaway here is that international bonds can offer some compelling benefits, but it's crucial to approach them with a clear understanding of the risks and opportunities involved.
Absolutely. And by considering factors like diversification, current market trends, and your own investment goals, you can make more informed decisions about whether and how to incorporate international bonds into your portfolio.
Well said. International bonds can be a powerful tool for investors looking to expand their investment horizons and potentially enhance their returns. But as with any investment, it's important to do your due diligence and approach them with a strategic mindset.
Thank you both. To recap, we've learned that international bonds come in two main flavors: developed and emerging markets, each with their own characteristics and risk reward profiles. By understanding these differences and considering current market trends, investors can make more informed decisions about how these bonds might fit into their portfolios.
And don't forget the importance of diversification and seeking professional guidance when navigating the complex world of international investing.
This has been incredibly helpful. I feel much better equipped to think about international bonds in the context of my own investment strategy.
That's what we love to hear. Since currency risk is a critical aspect of international bond investing, let's revisit it one more time in more detail.
Currency risk. Is that like the risk of losing money when exchanging currencies during international travel?
That's a great starting point. Just like exchanging money for a trip, investing in international bonds involves dealing with foreign currencies, and fluctuations in those currency values can significantly impact your investment returns.
Exactly. When you invest in an international bond, you're not only betting on the bond's performance, but also on the strength of its currency relative to your own.
It's almost like making two investments in one: the bond itself and the currency.
This reminds me of our discussion about risk and return trade-offs. It seems like currency risk is another factor to consider in that equation.
Absolutely. Currency risk is one of the key additional risks that come with international bond investing, but there are ways to manage it.
What are some of those currency risk management strategies?
One common approach is to choose bonds denominated in US dollars, which are often called hard currency bonds. This essentially eliminates direct currency risk. Another strategy is to use currency hedging instruments, which can help offset potential losses from currency fluctuations.
That sounds complex. How does currency hedging work?
In simple terms, currency hedging involves entering into financial contracts that aim to minimize the impact of exchange rate changes on your investment. It's like buying insurance against currency risk.
That's a helpful analogy. So hedging can provide some protection, but I imagine it comes at a cost.
That's right. Hedging strategies typically involve additional costs and can be complex to implement. That's why many individual investors opt for internationally diversified bond funds that handle these details for them.
So by investing in a diversified international bond fund, you can access the benefits of global bonds while leaving the currency management to the professionals.
Exactly. Diversification is another key tool for managing currency risk. By spreading your investments across multiple countries and currencies, you can potentially offset the negative impact of any single currency's movement on your overall portfolio.
That's a great point about diversification. It's a risk management principle that applies across all aspects of investing, including currency exposure.
This has been really eye-opening. I hadn't fully considered the role currencies play in international bond returns.
It's a complex but crucial aspect to understand. To recap, when investing in international bonds, you're not only exposed to the bond's performance, but also to currency fluctuations. While this currency risk can impact your returns, there are strategies like choosing US dollar-denominated bonds, using hedging instruments, and diversifying across multiple currencies that can help manage it.
Well summarized. As with any investment, it's important to understand the risks involved and to approach international bonds with a strategic, long-term mindset.
And to consider seeking professional guidance to navigate the complexities, especially when it comes to currency management.
Absolutely. That's sage advice for any investor venturing into the global bond market. Great points about the currency risk factor in international bond investing. Building on that, I think it's important to also consider the broader market-specific risks and opportunities in this space. What are some key factors to keep in mind there?
Absolutely. Each international bond market comes with its own unique set of characteristics and challenges. Factors like the regulatory environment, market transparency, local financial system stability, and even natural disaster or political upheaval risks can vary significantly from country to country.
That's a lot to consider. It seems like really understanding the local market dynamics would be crucial for making informed investment decisions.
Definitely. And that's where having a clear strategy comes into play. What would you say are some key elements of a successful international bond investment approach?
I think it starts with careful country and regional selection based on your risk tolerance and investment objectives. Understanding your currency risk appetite is also crucial, as we discussed. And of course, maintaining a long-term perspective is essential, as these markets can be more volatile in the short term.
Speaking of market conditions, are there any current trends or opportunities in the international bond space that are particularly noteworthy?
Great question. The international bond market is constantly evolving, but there are some promising signs, particularly in emerging markets. Many of these economies are showing resilient growth expectations, declining inflation, and potential for monetary policy easing. We're also seeing strong investor interest and capital flows into these markets.
That's really interesting. So, for an investor looking to capitalize on these trends, how might they approach incorporating international bonds into their portfolio?
I think the key is to view international bonds as a diversification tool. They can offer exposure to different geographic regions, potential yield enhancement, and a way to spread risk across varying economic cycles. But as with any investment, it's crucial to consider your individual risk tolerance and to take a long-term view.
That makes sense. So rather than trying to time the market or chase short-term gains, the focus should be on strategically diversifying and staying the course over time.
Exactly. And of course, given the complexities involved, seeking guidance from a financial professional can be immensely helpful in navigating these markets effectively.
Absolutely. While the opportunities in international bonds are significant, the risks and challenges are equally noteworthy. Having a clear understanding of both is essential for success.
This has been a great discussion. To summarize, while international bonds offer diversification benefits and potential yield enhancement, they also come with unique risks, like currency fluctuations and market-specific factors. The key is to approach these investments strategically with a long-term mindset and a clear understanding of the opportunities and challenges.
Well said. International bonds can indeed play a valuable role in a well-diversified portfolio when approached thoughtfully. Thank you both for this enlightening conversation. Join us next time as we discuss essential books on the topic of bond investing.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.